Welcome to the monthly Truck Stop webinar presented by the Motor Carriers Insurance Education Foundation as a part of the Transportation Risk Specialty. The Truck Stop are presented the second Thursday of each month at 2 p.m. Eastern Time. These webinars are presented as industry update for information purposes only and do not qualify for state CE credit. If you're seeking state CE, email trs@ibci.net and Beth will let you know about the CE programs that we provide, and we'll send you a list of those. If you have questions during the presentations, please type them in the chat window. They will be answered as time allows, or responded to after the webinar by a return email. And if it's a question that's generic to everybody or generic and available or should be information sent to everybody, we'll send everybody a copy of it. This webinar also will be posted on our website after we're through it within a couple of days. If you experience any audio problems, please send us a note in the chat window or call 800-741-4084. We will attempt to correct the problems as soon as possible. Understanding financial statements. This is the subject for today's truck stop. We received requests for information that would provide a better understanding of financial statement from a number of agents, a number of insurance companies. When I received the request, I thought of a friend that's a CPA. Our first meeting was over 25 years ago at a CIC program concerning trucking. And I asked him, what are you doing here? You are a CPA. What are you doing in the trucking industry? And so he and I developed a long-term relationship, and in my previous work with the American Association of Managing Agents, we've had the opportunity to use him on a number of programs. So when the question came up to me, I was able to contact him. Fortunately, my phone number had not, on my cell phone kept his number for many years, even though we had not contacted each other in a number of years, and it did work, and so we recontacted. So this opportunity not only gives us a chance to recontact with each other, but also a chance to provide information you needed for someone who understands financial statements, understands insurance, and to some extent understands trucking. So with that, Dirk, tell me about yourself.
Well, Ben, thanks, Tommy, and we've had a lot of fun together teaching, and I really enjoy working with other business people who maybe don't understand all the mechanics of the accounting to try to teach them what I know to be able to better read and understand a financial statement. I was a CFO for 3 different companies for the first 10 years of my career, and now for the last 25, I have a CPA firm. We're based in Wisconsin, but we have clients in 22 states. We have a specialty in doing work for insurance firms, but also manufacturing and distribution and transportation and a variety of industries. And a lot of my work is in working with business owners and their accounting staff to read their financial statements, do their accounting, give tax advice, merger and acquisition advice in a wide range of financial management areas. And so that's my goal today, to try to offer whatever advice I can to be better at reading and understanding financial statements.
Obviously, this is our program, and Dirk is agreed because we get questions all the time, and he is available for you all to contact if later there's any specific questions or if you need more detail in any certain areas. He's been a friend to our industry and to us for a long time. As you know, a lot of your insurance carriers ask for financial statements. It likely depends on the size of the motor carrier, meaning how many power units. Typically, financial statements do not become a absolute request until you get over 25 units, where you're looking at writing the fleets based on a revenue source as a basis of premium or mileage that's coordinated with a financial statement and with IFTAs. So it differs. So you need to find out from your carriers when they require financial statements and make sure if they do, they are provided timely. A lot of your insurers don't want to give it to you, the agent, because they don't trust you from giving to other people. You know, a lot of local business concerns don't want someone who's competing in the marketplace, even though not in the same business, I know their financial position. A lot of times, and I've had in the past where I've had them send it directly to the insurance carrier, to the insurance carrier to meet that requirement to have. Even if it's not required, though, it's a valuable thing to look at and to give because it gives a picture of your insurance operations beyond just if they make a payment. I've said often that you can go down to a local drugstore or grocery store. If they don't have a bad check posted, you can check with the tire company and the fuel company if they're paying their bills. They're doing pretty well in this industry. Well, you need more than that today with everything going on and the various models that you have. So to that area then, we'll look at the financial statements and go through them. We don't have a generic one here. We're just going through terms and information, how you look at them, how you can use that information. So Dirk, let's start talking about this.
You know, what's interesting, Tommy, is I think there might be a perception sometimes that all financial statements are created equal. And even though the CPA industry tries to standardize the method of accounting, the formats, those kinds of things, I'm still surprised by the type of variety that we see, some inconsistencies in the variation. So what I'd like to do today is talk about some of the standards and some of the considerations that the reader of the financial statement should be thinking about so that they can be asking questions and looking at the statements with a certain level of understanding. When I talk about financial statements, there are two basic statements that nearly all businesses produce, and those are the balance sheet and the income statement, and sometimes the income statement is called the profit and loss statement. The balance sheet is a statement of financial position, and what that means is it lists certain account balances, what the balances are at a certain time, and kept according to certain standards. So the balance sheet would have a listing of the assets of the business. The assets are items of value that are owned by the business. It would also list their liabilities. Liabilities are the amounts that are owed to others. And it would show the difference between the assets and liabilities. That would be the owner's equity. That is just the difference between the assets and liabilities. When a balance sheet is shown, the amounts are presented as of the end of that accounting period. It might be the end of the month or the end of the year. And it's often shown in comparison with another financial date. It might show these same balances as of the end of the prior month, so we can see the change in balances for this certain month that we're in. It also might show the balances as of the end of the prior business year, or it might show the balances as of 1 year ago. So if we're looking at the June 2016 financial statements, we would expect to see the June 30th balances for the assets, liabilities, and equity. They might be compared to the end of May 2016. It might compare to December 31st of 2015, or it might show June 30th of 2016. And the comparisons are important because we can see the change in these various asset and liability balances, and the change will show some trends. So first statement would be a balance sheet. Many times the balance sheet is sort of underestimated in terms of its value, and when we cover this in more detail, we'll show some of the importance. But the first important statement would be the balance sheet.
Dirk, let me interrupt you half a second here. If these previous years, because the ones I see are not shown, as an insurance agent, I don't think it's something we need to be upset about. It's just that maybe advise our insurer that they need to go to an accountant who does this. It clearly helps us show the time changes, and from an insurance standpoint, as you know, we base a lot of our decisions on the consistency of the operation, meaning we're providing coverage in the future based on their past history, and the more past history you have, the better understanding of able to correlate that to what the projection of the future are. So it is important to see this rest of that stuff. But this is the gap coverage, and I know this is typical of the ones I have seen. Are you saying that most people who have it done from an outside source shows this, and later we'll talk about the inside QuickBooks type of things, but they should be showing these things, correct? But it's not something you get all upset about if it's not.
That's correct, but a lot of times the people will produce whatever is being requested, and so if a request is made to show me the current balance sheet, and if the request says, and show me with a comparison to prior year or the prior year end, a lot of times that format is available. It's just that it might, if it's not requested, it may not be provided that way.
That's a good point. So when we have people who are listening to this that are involved in maybe the underwriting viewpoint, that would be something that you might want to add when you ask for financial statements to look at the comparisons. If you've got 2 or 3 years comparisons, then you only need that one statement versus asking for the last 3 years of worth of statements. Can all be done at one time versus coming up with a second one. That's a good point. Thank you for adding that part of it, Derek.
The second statement would be either called the income statement or the profit and loss statement, or P&L. CPAs normally refer to this statement as the income statement, but I'd say that a lot of lay people and business owners will call the statement the P&L, or profit and loss. And it's a statement that shows the revenues of the business, and revenues are the source of the income. It would be sales or, and primarily the sales function of the business. It would show those accounts. It would show also all the various expenses that the business incurs, what I think of as the use of the funds, which would be, salaries and rent and equipment and depreciation, those kinds of things. And then the difference between the revenues and expenses would be the net income or loss, or the net profit or loss. In the same way as a balance sheet might show comparisons, even more so an income statement will often have more than one column of data. It will typically show the revenues and expenses for the month that we're in. So if we're looking at the June financial statements, we would see the month of June, the revenues and expenses for the month of June, and we would almost always see the year to date in a second column, and that would be if our business year runs from January through December and we're looking at the June income statement, we would see the cumulative revenues and expenses from June to, or from January 1st to June 30th. So always at least two columns, the current month and the year to date, but often we can see a comparison for the same period for the prior year. So it might show June of the prior year, let's say 2015 in this example, and it might show the prior year cumulative from January through June of 2015. Sometimes income statements can be shown in comparison to a budget. If the company does a budget, we could show the actual revenues and expenses against the budgeted revenues and expenses, which will even provide some additional data. So revenues and expenses for the month and year to date, and often with comparisons to prior year, and sometimes in comparison to the budget. Tommy, anything else to add there, or any questions that come to mind as we just do an overview of the income statement or P&L?
No, we'll get the view detail. The only point I was trying to make is that we deal with truckers. A lot of them are very small. They might not be as sophisticated. We'll talk more about that. I just want to make sure people understand what is the standard and not to be upset if it doesn't actually meet those formats, but also something that would be reasonable to request, because I think later you'll even say QuickBooks and other things are able to prepare these things. And as far as the budget goes, this just means if they do have a budget, at least they got a business plan, and talk about that budget being on projection or not, which is important to understand how they're running their business. But thank you. Let's go ahead and look in more detail then.
Okay. So these would be the two basics, the income statement and the balance sheet. We'll go to the next slide. Sometimes a third statement is included, and this would be the cash flow statement. Often a cash flow statement is not prepared unless there's an outside CPA involved, or if the internal bookkeeping and accounting department is a little more sophisticated, they might show a cash flow statement. But I wanted to mention it here because if it is available, it's an important statement, and if it is made available to an underwriter, I'd want them to be able to understand what they're looking at when they look at a cash flow statement. The purpose of this statement is it reconciles the net income or loss that number comes from the income statement, to the change in the cash account on the balance sheet. The cash account is an asset, and so assets are shown on the balance sheet, and the net income can be reconciled to the change in cash account. From a layperson's standpoint, it might answer this question, and this is a question that business owners have all the time. If I made a certain amount of money, as reflected on the income statement, where is it? So if I made $100,000, because that's what my income statement shows, where is the money? Well, it's surprising that the answer to that is not as obvious as somebody might think it is. You might say, well, if I made $100,000, didn't my cash account or checking account increase by $100,000? No, because the amount of money made is not necessarily sitting in the checking account, and there are a typical number of reconciling items that would get the net income to be adjusted to the change in the cash balance, and that's what a cash flow statement does. And here would be some of the reconciling items that adjust the net income to the change in cash. Some would be these kinds of things. Depreciation is an expense that would be reflected on the income statement, but depreciation is a non-cash expense, and so it's one of the reconciling items. Also, sometimes cash is used to purchase equipment. It's exchanging one asset for another. So we made a profit, but we used that profit to buy another piece of equipment, and that equipment hasn't been fully expensed on the income statement yet. Sometimes money is used, cash is used to pay down previously obtained debt. And so debt has been repaid, but it's not, debt payments are not shown on the income statement, so it's got to be adjusted as a reconciling item. Other things, sometimes owners take cash out of the business as a profit distribution, but it's not reflected as an expense on the income statement, so cash has been used, but it doesn't on the income statement. Other times, receivables and payable balances are being increased or decreased. They are the sources and uses of cash, but they're not run through the income statement. They're just adjustments on the balance sheet, and so it's not always intuitive that those things are sources and uses of cash, but are not run through the income statement. So I think from a 10,000-foot level, what I'd like the attendees to understand is not all cash coming in and going out is being run through the income statement. Sometimes they're just adjustments on the balance sheet, and the cash flow statement would start with the net income and go through all the other changes in cash balances that are not being run through the income statement as a way to reconcile net income to the change in cash. And that's what the cash flow statement does.
Don't you find most often they're asked not where all the profit is, but what do you mean I got to pay taxes on that much? Because
well, that's right. That's right.
Where's my money to pay the taxes, even though it shows a profit? I appreciate that. That's a good comment here, and we got a little bit later, particularly trucking, where we do have the choice later of accelerated depreciations or not, and actually what's the equipment worth versus what it shows on the book. So those are things there that are important. The down payment on the equipment, if not pay the whole amount of the equipment, you make the down payment, which is cash item, but you put it on the books and you depreciate it at a different level than what that down payment is. And even things like insurance deposits that you have that then will be accrued over a period of time versus immediately when you look at the cash statement at any given point in time.
That's correct. And so if the attendees understand that just because there's an amount of net income showing in the income statement, that doesn't mean that all of that profit is sitting in the bank account, because other things are also moving within the business. Okay, let's talk a little bit about the different types of statement preparation. I said at the beginning, there's sometimes people are surprised to find out there's a little less consistency in the keeping of books and the reporting in financial statements than somebody might assume there is. When financial statements are prepared, they're either prepared by the in-house accounting or bookkeeping staff. And almost all small, even small businesses would have an automated accounting system. They would have a computer where they would use the software program, either QuickBooks or Great Plains or Peachtree, or there are a variety of accounting programs that are used. And I would say the popular ones are actually fairly sophisticated in terms of the type of accounting reports that can be generated. But because sometimes the bookkeeping staff internally maybe doesn't have quite as much technical accounting knowledge, they might not be as sophisticated of reports as you might see from a CPA. That's not always the case, but it's sometimes the case. And so from the attendee standpoint, they should understand, are we looking at financial statements that are prepared by the in-house accounting staff, or are they prepared from an outside accountant or CPA? Not always, but typically an outside accountant, that might be an outside bookkeeping firm, they may not be CPAs, or if it's an outside CPA firm, because they do this professionally, would typically have what I would call more sophisticated formatted financial statements, and there's an assumption that the books and records are probably, although not always, kept in a more accurate way. If the outside accountant or CPA prepares financial statements, there is one of 3 levels of service that a CPA can use to prepare financial statements. The first one is a compiled financial statements, and in that one, that's the lowest level of service that a CPA can provide. It does mean that the CPA looked at the financial statements, and they did take the internal statements and put them in the CPA's format, but they did not verify the accuracy of the financial statements. They may have asked some questions, but they're not taking responsibility for the accuracy of the financial statements, and they didn't put the financial statements through any series of tests or inquiries that you would find in a higher level of service.
Dirk, that's typically what an accountant provides too, or a bookkeeping service provides, just that compiled part. Am I not correct? And isn't that the big difference between an accountant and a bookkeeping firm and a CPA?
That's correct. I would say that whether or not they're a CPA or not, the compiled financial statements from any outside accounting firm would be similarly prepared.
Okay.
The second level of service that only a CPA can provide is a reviewed statement. And the place to find out what level of service the accountant has provided is when you get financial statements from an outside provider, not only is there a cover sheet that would say the name of the company and the date that they're prepared, but there's a letter that the outside accounting service provides with the financial statements. It's called an opinion letter or a statement of service. And when you read that letter, one of the first things that letter says is they'll say, we have either compiled or reviewed or audited the financial statements. In that initial paragraph that is on the accountant's letterhead, they'll tell the user, this is what we've done. And the key word is we have compiled, or we have reviewed, or we have audited. And a reviewed statement is a fairly sophisticated financial statements because the CPA is required to go through a number of inquiries to look at some of the internal books and records and some of the supporting statements, bank reconciliations and equipment listings and things like that. And so it's been through a fairly significant level of inquiry into the accuracy and the accounting methods of the client. And so there's typically the format will be fairly sophisticated. There are probably notes to the financial statements, not only the statements themselves. It'll have an income statement, it'll have a balance sheet, it'll have a cash flow statement. But then some of the accounting rules and some of the assumptions that were used are included in the notes to the financial statements, which are very helpful in understanding the methodology that the accountant used, some of the assumptions, some of the application of generally accepted accounting principles, fairly sophisticated. Any questions, Tommy, or other observations on a reviewed financial statement?
Well, I just want to make a point in this area that most of the smaller truckers we have the compiled statement. Typically, I don't find them going to a reviewed statement, audit statement, unless they are held by ownership is diverse, meaning not family, not themselves, and the partners or the people involved in the business want to know about that, be reviewed or even audited part of it, or they're dealing with an entity that requires it, like a bank borrowing money or loaning money, or maybe even a leasing company to verify the financial statement to lease equipment, or in the industries which we don't get much involved in here would be bonding. Maybe one of the times if they are a truck broker or something like that, they require a bond. Sometimes the insurance companies will require one of the statements more than compiled. But most of the people we're going to run into will be compiled unless they're larger trucking companies.
Okay, and I agree with that, that typically the thing that will trigger a higher level of service will be a bank requirement if there's a lot of debt. Just for information then, even though many of the attendees don't look at audited financial statements, that's the third and the highest level of service. And what a CPA does there is they will independently confirm all of the assets and liabilities of the business. They'll make contact with or inspect the assets, do confirmations with banks, do confirmations with the trade, the vendors and such, so that they independently confirm the accuracy of all those balances. A much more sophisticated process, fairly expensive, and not often required unless there's a bank requiring that because of exposure purposes.
And I think what we need to look at here is that when we ask for a financial statement, whether it's in-house or done by accountant or CPA, most of them are going to be compiled. And so it really, other than the format itself, and maybe if it's done by an outside firm, the things are better classified, but the accuracy will not be that much difference between the in-house and these other people, accountants or CPAs, other than making sure it's classified correctly, but nothing's being verified.
Right. Sometimes businesses don't keep very accurate internal books, and they rely on the income tax return for the financial statements, and income tax returns do include both an income statement and often a balance sheet. The format of it, of course, is unique to the IRS requirements, but the same data would be found in an income tax return, both an income statement and a balance sheet. The basis of accounting, I think it's important when somebody's looking at a financial statement to understand what is the basis of accounting, and by that I mean what is triggering the recognition of an accounting entry in the books. And there are three standards or three often used accounting recognition rules. Some businesses use a cash basis of accounting. They don't record an entry in the books until either cash is received or cash is dispersed. That would typically be smaller companies, a little less sophisticated companies. They would be on the cash basis of accounting. A more sophisticated level of accounting recognition would be the accrual basis of accounting. And in the accrual basis, accounting entries are made when revenues are earned, even though the cash is not received yet, or when expenses are incurred, even though they're not paid yet. Accrual accounting would be considered generally accepted accounting principles. It's what CPAs suggest would be a proper method of accounting. And when a CPA prepares a statement, a reviewed or an audited statement, especially, those must be kept on an accrual basis. They're considered more accurate because it more properly recognizes accounting transactions when legal commitments are made, even though the cash has not been received or paid yet. Tommy, anything you want to add on the cash versus accrual method of accounting?
No, that's probably the difference in having here, and you're right. Most of the smaller business we're going to use is the cash basis, but if they have receivables that are really assets, then they don't show that, or if they have debt, that's the way they hide debt. So you need to look at beyond that. So this is where you balance those two things. But no, we're fine. And of course, the tax returns are also based on the combination of those things.
That's correct. Yeah, the IRS sets the method of accounting, and based on whether it's a small company or a larger company, it's typically some combination of cash or accrual. All right.
Yeah.
Next slide, we'll talk about, I think it's important when somebody's looking at financial statements to look at trends, and we would suggest that 2 or 3 years worth of financial statements would provide a better picture than just a single year or a single period. Keep in mind that businesses are on they're on a business year. Many small businesses are on a calendar year, but some businesses have picked a 12-month period that is other than the calendar year. It might be July 1 to June 30th or any other 12-month period. We would call that a fiscal year, F-I-S-C-A-L, which means their business year. Sometimes insurance renewals are coming up mid-year, and if we're into a mid-year period, we're into June, July, August, it would be appropriate not only to look at the prior year-end financial statements, but also look at the current year, mid-year financial statements through June 30th or July 31st, and often to get those in comparison to the prior period at the same time a year ago, again to see trends. Are revenues growing? Are profits increasing? Are they declining? When you compare things year over year and mid-year over mid-year for the same period, important trends are identified, whether the business is getting stronger or weaker. Is their cash balance building? Is it declining? I think very important things.
Yeah, the only thing I've mentioned in this, I have dealt with this often, and when I see a policy renewed in the middle of a month even, my question is why, particularly if it's an audible policy, to keep it around at least even quarters, if not even years, make you're able to correlate the policy period with the financial information that you have. So if particularly if the policy is written on an auditable basis, where after it's over, they'll come in and look at revenue, or they'll come in and look at payroll for work comp purposes or general liability purposes. It's so much easier if it's around their business year or from a tax, the unemployment tax return, at least around a quarter, to correlate or to reconcile those based on the policy being audited. One truck, it probably doesn't make much difference. Or 3 trucks, it probably doesn't make a difference because those are not typically audited. But that's a concern, to try to balance the policies, particularly auditable policies, around something that matches the financial information available.
Well, I agree, and because transportation, it can be a volatile industry, if you're not seeing financial statements that are maybe up to the most previous quarter, there could be a lot of either better than or worse than performance that you're not seeing since the end of the last year, so mid-year statements can be important. The other thing I'd point out is, when you're asking for financial statements, make sure that if you're asking for year-end statements, it's the year-end statements after all adjustments have been posted. Sometimes, especially smaller companies, they'll do their internal books, they'll close their books, then they send them to their outside accountant to do the tax return, and often the outside accountant will make some adjusting entries to tax return, clean up depreciation and do a few other things. Then they'll send those entries back to the small business, and the business then has to post those year-end closing entries, which can be material and significant. And so sometimes by comparing the internal financial statements to the tax return, you get a pretty good view of whether the internal statements have been adjusted to the tax return. Most tax adjustments are adjustments that move the net income lower. They tend to be more conservative adjustments, and so I would say you're not really seeing the full picture until those internal statements have been adjusted for the accountant's year-end entries. All right, we'll go to the next slide. Now a little deeper dive in the balance sheet. We've already said that it's a statement of financial position. It has assets. Those are items of value, liabilities, amounts owed to others, and equity, the difference between the two. Often the balance sheet is formatted in a certain way, with the most liquid assets showing first, and as you move from top to bottom in the balance sheet, it'll show lessening of liquidity of the assets. So we'd often see categories on the balance sheet of current assets. Those are either cash or items that will be turned into cash within a year. And then the property and equipment, the trucks, the trailers, the other kinds of equipment, and then other kinds of assets. And again, the more sophisticated the financial statement, the more sophisticated the presentation in terms of current assets, property and equipment, and other. Current assets would include cash and other liquid assets, maybe bank CDs and things like that. It'll give you an indication of whether they have enough money to meet their current obligations. We would also see their trade receivables, the amount that their customers owe them for the work that they've done. And I think it's especially important to see a supplemental report that would show the aged accounts receivable. We might show that the total receivables might be $200,000, but how old are those receivables? By seeing an aging report, you'll see whether those are for work done in the current 30 days or whether we have customers that owe us from 90 days past due to 6 months. It'll give you a good indication of whether those receivables are really collectible or not. Sometimes, let's say for insurance and some other things, money has been paid up front for something that they'll get value for the coming year, and so prepaid expenses are sometimes an asset that you'll see under the current section. Then sometimes companies loan their shareholders money. The shareholder takes money out of the business and intends to pay it back, but sometimes shareholders don't always want to pay or don't plan to pay borrowed money back to their company. So if you see a shareholder or other receivable, it would be important to know, is this being amortized or paid on a regular basis, or is this really what's going to end up being a distribution to the shareholder that we're just trying to prop up the balance sheet and not really reflecting that this money has already been spent and will be collected?
Also would have a tax consequences sometime. There's one other account they might have. If they use owner-operators, the requirement is to keep an account of the owner-operators. A lot of times the motor carrier requires an owner-operator to have a deposit or have things they pay in case of a cargo claim or physical damage claim later. So you'd be looking at those two, and that would end up being an obligation back to the owner-operator in that area. But if they could have an account on the balance sheet for the cash that came in from the owner-operator's trust account.
Okay. And would they normally call that a trust account or a deposit account? Is there some standard wording you would?
There's a requirement on the FMCSA leasing requirements for it to be kept separate. It's a requirement for interest to be paid on it. It's a requirement for it to be returned on in a set time period. So they do have to account for it. And a lot of motor carriers require $500 or $1,000 to pay for the fines or penalties or, again, small deductibles of cargoes or things like that. So I'm not sure exactly what it's going to show, but typically you would say, because it is cash they're holding, but yet there would have to be a liability against it. So I don't, when they show it separately, Dirk, I don't know how it would typically be there, but you could have that if they're using owner-operators because the government requires it.
All right. Then if we go to the next slide, you'd usually see a section on property and equipment. Sometimes this is called fixed assets, but it would be all of the trucks, the trailers, and other equipment that they have. A couple things that are important about this. Accountants require that when a truck or a trailer or other piece of equipment is purchased, it has to be recorded on the books at its original cost. And so if you see the asset account that's called, let's say, equipment, the amount in there would be the original cost of that equipment. Then as that equipment is used in the business, and so the value of that equipment is going down, the way that accountants keep track of that is they create an offset account called accumulated depreciation. And the accumulated depreciation will show right under the asset account, and you'll see that that balance in accumulated depreciation usually has a negative sign next to it, or it's in brackets to reflect that the original cost of the equipment is being used up over time, and that usage of it is being accumulated right underneath the original cost. So that if you take the original cost and subtract out the accumulated depreciation, and the balance sheet will do this, it'll show a net value of the owned equipment. Accountants would call that net value a book value. But that book value doesn't necessarily mean that's the fair market value, because there's a lot of flexibility and inconsistency in the way that depreciation or the useful life of equipment is reflected. The income tax rules, which are often applied to small businesses, they want to keep their books in as simple a way as possible. So often depreciation is reflected on a tax basis. Well, Congress is always trying to manipulate and spur the economy, and so they often allow businesses that buy equipment to depreciate it very, very quickly. And when tax depreciation rules are used, often you'll see that equipment is being expensed out and depreciated much faster than it's actually declining in value. And so in a case like that, the book value or the net value that's showing on the balance sheet might be much less than that equipment would be worth if we sold it. Other times, businesses use a little bit more sophisticated methods of accounting for depreciation. We would call that a book method, and it might be some sort of straight line method or slower method of depreciating that equipment. And we would call that a book method, and in those cases the book value might come closer to approximating the fair market value. But I think a legitimate question for the user of the financial statement is to say, what method of depreciation is being used? Is it a tax method or a little slower book method? So we get a little bit better sense of whether the book value is reflecting fair market value. Tommy, anything you want to add on that? Because it's an important piece on the balance sheet of a trucker.
Absolutely, and that's the thing, and you pointed out here. I've always had this problem. The stuff that's shown on the balance sheet as far as the value of the truck, in most all likelihood, is not actually what the truck's worth. Early on, that's probably worth far more than that. At some point in time, it might separate, and the reason your insurance do that, obviously, Dirk, is to save taxes. Because correct. They delay the payment of those taxes until later. It's just a really delay the payment of taxes, because sooner or later they do. There is a point here, though, also, if it's over depreciated so much and it's worth more, if they then sell it, then they have to accumulate some of that profit back. So there's a balance that they have to work those things out. But the point that you made is absolutely correct. We look at the balance sheet and look at the equipment purchased and the value of the equipment. That's not what you should write the physical damage policy on, and that's not actually their actual worth. It is the equipment might be worth, and then most likely it is worth more than the book value.
Correct. One of the other key things when we're looking at the assets is a lot of truckers will lease their trucks, and there are two types of leases. Let's say that a trucker leases a piece of equipment, and effectively in the first 5 years they basically pay for the entire piece of equipment, so that at the end of the lease term, let's say at the end of 5 years, they can then buy the piece of equipment out for a $1 or a nominal amount of money. Even though that might be called a lease, the legal document is a lease document, what accountants say and what the IRS says, if in the first 5 years of a lease, you basically are paying more than 90% of the value, so that when it comes to the end of the lease term, you can buy that lease out for a nominal amount. Even though it's called a lease, accountants think of that as really a purchase, and they recommend that purchase accounting be done for these leases that we call capital leases, because they're really in the nature of a purchase. That would be compared to an operating lease where you pay a monthly amount, but then at the end of the lease term, if you want to buy it, you have to pay full fair market value for that piece of equipment. There's no bargain purchase option at the end of the lease. And we would call that an operating lease. And for operating leases, accountants wouldn't recommend that you do purchase accounting. You wouldn't put the piece of equipment on your balance sheet. You wouldn't put the obligation as a liability. So I think the user should be asking and understanding, for the leased equipment, are they doing purchase accounting for capital leases or not? Because sometimes a little less sophisticated bookkeepers and accountants If it's a lease, they don't do purchase accounting even on capital leases, and it's a very material item.
One of the concerns that we have looking at the financial statements, trying to reconcile the number of units they are operating, and this also gives us, if the value of the units do not match, or at least the original cost of the units do not match what revenue will be generated, and later we'll talk about that revenue, then you know they're using owner-operators, or there's vehicles that you have not been developed. So there is a relationship between how many trucks I've got, versus, which is a reflection on the value of those trucks, at least the original cost of those trucks, and the revenue those trucks generate. So here, if things don't seem proportional, then you might know they're using independent contractors or owner-operators. That would be the point that I would want to make as far as this goes.
I think with regard to the leases, it would be appropriate as a supplemental schedule to ask a trucking firm for a listing of all their equipment leases. It's a very material part of their financial statements, possibly their assets, and certainly their obligations. And unless they have fairly sophisticated books, you might find a number of things by looking at a lease schedule that would give you a lot of additional information besides just looking at the balance sheet. Okay. Then if we drill down a little bit further, sometimes businesses also own their building. Although it's common, when a building is owned, it's probably not owned in the same legal entity as they would be running their trucking business. For certain tax reasons, they would have often set up a separate legal entity, often a limited liability company, to own their building. But if they own their building in a separate legal entity, often they've executed a lease between the trucking firm and the real estate firm in order to pay rent and for those obligations. So an important piece of the financial puzzle. Tommy, anything else you want to say about building and contents?
No, those are just not cash items, and we're there, but a lot of times we can't look at that as being able to truly worth. They might show worth, or they might be worth more, because we recommend obviously separating, and we recommend for tax purposes putting them in a family trust or things like that. The question you have here, and from an insurance standpoint, if they have those things, one of the things I think a lot of agents and a lot of wholesalers overlook is the opportunity to also insure those buildings and the contents. And the more you insure of these items, the better off you are from your relationship with your insurance. Even though we focus on the big dollars trucking, the hard equipment, these other things are things that we might want to look at that you might want to offer insurance coverage for.
Right. And another thing about equipment is sometimes businesses, before they capitalize or put an asset purchase on their books, they have a certain threshold of what they'll capitalize. Maybe it's $1,000, maybe it's $5,000. But if they're aggressive at expensing these small equipment purchases, there could be a lot of value in contents and equipment that is not showing on the balance sheet. And that might be another question, is what is their capitalization policy? Do they have a lot of equipment that's not showing on the balance sheet because they just expense it when purchased, but it still has value, and if there was a loss, they would expect some insurance coverage on that equipment?
Well, another side of that, they expense it out. But a lot of times in trucking, they expense out, they keep spare tires around, and they're sitting there in inventory that they don't really account for because but they can be used later. It's really an asset to them to be used. Or a lot of the shop equipment from the diagnostic equipment, all that, which will have a lot of value from a tax standpoint. As you know, the IRS will allow you to expense those things out up front, so they don't pay taxes on them, even though they have a usable life beyond the term we deal with. But that's things we want to look at. But I'm okay.
Okay. All right. Other things, sometimes you'll see some other assets in the balance sheet. Maybe they've made some other investments. Maybe they have some intangible assets like goodwill or covenant not to compete, which come about when businesses buy other businesses. Sometimes they account for things as these intangible assets. Not a lot of insurance impact, I don't think, but sometimes you'll see some other assets on the balance sheet. If there is anything material, it's certainly prudent to ask, what is this asset, how did it come about, and does it have any insurance ramifications to it? Then if we look at liabilities, remember the balance sheet has assets, liabilities, and equity. Liabilities are amounts owed to others, And often you'll see two different sections of liabilities, either current liabilities or long-term liabilities. Current liabilities are obligations that should be paid within the next 12 months, and long-term obligations are those obligations that have a due date farther out than 1 year. This could include debt on the equipment, payables to banks, or leasing obligations. Are primarily the ones that we would see. If we go to the next page, there might be lines of credit. That's a debt that's owed to a bank. It's often used for working capital and other purposes. And this is one that I always pay close attention to. Are lines of credit growing or shrinking? If you're looking at several years with the balance sheets and you see a line of credit during a certain season, it's high, and then it gets paid down during a more profitable season. That's the way it should work. Sometimes you see lines of credit that as the years go on, they keep growing, and it seems like they keep needing a larger and larger line of credit, either because they're not generating enough cash from operations to pay their bills or some other reason. I look at the trend for line of credit. I think it's very important. The debt to independent contractors, other trade payables to other vendors, and just like receivables, I might ask to see an aging of trade payables, because when businesses get in trouble, they start to stretch their vendors out, and I want to see whether they're keeping their payables paid within 30 or 60 days, or whether they're stretching them out to 90 days or more. It can show, that can be an early indication that they're having some cash flow problems.
The important part of this is the debt to owner-operators. Again, one of the things that we're concerned about from reading a financial statement, are the insurers using owner-operators or not? Do we know about all those owner-operators or not? So you have the debt, first that trust account that we talked about that government requires, but second is, what kind is that debt? Typically an owner-operator will be reimbursed immediately after the trip, or having even an advance before the trip's made. So sometimes that debt to owner-operators actually might show up as a positive, Dirk, versus a negative, particularly if they do advances and stuff, because you don't typically owe the owner-operator until the load is completed. So that could vary a little bit. So even if it's you could have in a liability a positive thing, that's because they give the owner-operator, they typically give the owner-operator advances, and then they reconcile it as a later when it's paid. Could be a week later, or even 2 or 3 weeks later, depending on their arrangement to pay owner-operators, and they might keep it as an advanced account until the whole trip is paid for and over with.
Okay, very important. Sometimes you'll see other debt on the balance sheet. Maybe a trucking firm had multiple owners and one retired and they're buying them out. Maybe there's some other debt, but again, to know what it came from, and does it look like it's trending in the proper way that debt is being paid down and the balance sheet getting stronger. Then I would go next slide. Other obligations and commitments. A lot of times balance sheets won't show things that aren't, well, obviously they haven't been recorded in the books, but sometimes they do have some tax liabilities and maybe some judgments against them. Again, especially if the balance sheet is prepared internally, sometimes they're not recording some of these other obligations, where if it's a CPA or outside prepared balance sheet, a lot of times that's a requirement through these inquiries that they'll show all obligations and commitments on the balance sheet, but sometimes internally these things won't be reflected. But that would be a prudent question to ask of the insured: are all liabilities and obligations currently reflected on the balance sheet? All right, next slide. Then we get to the equity section. It's a more complicated section, and I would just add a couple of comments about it. First of all, the amount of equity, it's just the math. It's a simple formula that the assets, the total assets minus the total liabilities, equals the amount of equity. When you look at the equity section, though, you'll see several accounts, depending on if it's organized as a corporation or a limited liability company or a partnership. The names of the accounts can change and will change, and sometimes you'll see that the initial invested capital in the business is called common stock or paid-in capital. If it's an LLC, it might be called member interest. If it's a sole proprietor, it might be called owner equity. Then the equity is also being adjusted for whether the business is making or losing money and whether the business has retained those prior year profits or distributed them, and those would be in accounts called retained earnings. So I think at this level, my goal is only to say that equity equals assets minus liabilities, and when you look at the equity section, it'll have these various accounts, but what I would be looking for would be to say, over time, is equity increasing or is it decreasing? Because that gives me an indication whether the company is getting stronger or weaker financially. Anything else in the equity section, Tommy, you think? Okay.
Well, other than it's not really what the company's worth, but what you just said because of the things you have, but that's a big part of that. And some of it's good and some of it's bad. If they're taking the owner's equity is good, I mean, how they take it out and you know, whether it's how they distribute it personally or not. Let's go ahead, let's go to profit and loss and or the balance,
Very good.
financial stuff.
All right. To summarize then on the next slide, I'll say that the balance sheet shows a lot about the insured in the areas we talked about, and it often is underappreciated by the users of financial statements. Let's go to the income statement then, and we talked about that an income statement or a profit and loss statement, or we can just call it the P&L, is the revenues minus expenses, then that equals on net income or loss. And we often want to see comparative income statements because we're trying to understand, are revenues increasing or are they decreasing? Is the business getting more efficient or less efficient? That is, as it grows, is the net income increasing, or is it getting somehow less efficient because it's having to add more infrastructure, more costs? And so by looking over time, you can see the revenue and expense trends and get an idea whether this business is getting stronger or weaker. So it tells whether the business is making or losing money. It should be pointed out, though, that whether it's making or losing money, that doesn't always show you whether it has positive or negative cash flow. Remember, cash flow is a little bit different than profit, but profit is a pretty good indication to start with about whether the operations are favorable or unfavorable.
And in the trucking industry, the big difference there is it not, Dirk, is how the depreciation is taken.
That's a very key factor. A very key factor is whether, when you're looking at the P&L, have depreciation in it, and if it does, is the depreciation accelerated, a fast depreciation according to a tax method, or is it a slower depreciation according to a book method?
Right.
Tommy, on the revenue section, I'd like you to address some of these.
I'm just trying to relate this thing is a simple thing. You got some non-trucking revenue that you'd have to worry about, depends on what they're booking, warehousing, or they might have a service facility, they do outside work, or they even might show revenue from owner-operators when they work on operators' trucks. They could have things that you want to look at, but there is a relationship to number of power units and revenue. Based on the American Transportation Research Institute's last study, a truck on the highway costs about $1.76 a mile. Typical truck's about $100,000. So for every truck you're looking at from an expense standpoint and a revenue standpoint, you're dealing with close to $175,000, $176,000 worth of costs. Again, trying to look at those items, and later we'll talk about the revenue then must cover that. So they got to be on the next slide, Dirk, if you would.
Okay.
So you got a revenue here. Rate right now is about 210, 220. Those are loaded miles. So you have to look at the position. So when we look at revenue and expenses, we realize that typical trucks will cost about $175,000 to $176,000 a year. The revenue should be about $200,000 a year. Just trying to balance those two things for someone operating over a 300-mile radius. So they can use this to determine how many units they've got, whether they owned or not, because they could be generating these with owner-operators versus own equipment. The other part of this is you also would have more revenue if you have a brokerage. This is where a lot of motor carriers generate additional revenue without the direct expenses, because a broker just takes their money off the top. So this is what we're just trying to look at, okay? You got another trucking thing is fuel surcharges. They might keep those separately. If you got a revenue-based premium, that's a discussion item. You got to clear that up. And we also talk about your warehousing that will be involved in the property. And they also are now looking at some, and the government now allows some waiting time, which is not really revenue of the truck being run. Those are things that the shipper are having to pay if they cannot load the truck within a given period of time. A lot of the insurance company, a lot of the motor carriers are requiring the trucker, and even the government's talking about making it mandatory to pay the trucker for having to sit there. Most of that goes into the driver. But when we analyze this, the point I'm trying to make is there is a relationship to a number of revenue needed to keep the trucks on the highway. The fuel surcharge is a debatable item if your premium is based on receipts that you need to clear up front, as well as taking these other items out that are not truly the items that talk about a truck on the highway. And that's the premium base we talked about. And the stability. There's a past projection to exposures, how they're influenced, or how stable they are. So we got to make sure we all understand what the premium base is, if that's premium base. And again, watch brokers or receipts from non-owned autos that can affect those things.
All right, we've already covered a lot of this, that profit equals the net income, but cash flow can be different, and I just recapped the reconciling items which we've already discussed. Here are some of the benchmarks, Tommy, that could you review?
Well, again, today the trucking industry is actually making more money than before. The history shows they make 3 to 5% of the net revenue is their net profit. A lot of times the smaller units, because of this depreciation and because of the cash flow, they don't balance those things in, and they don't accumulate for future costs. Maintenance actually doubles at about 450 to 500,000 miles a year. So there's a point to keep the average unit of in the age of the unit. The older units are going to cause more maintenance later than the newer units here. And we already talked about the relationship, depreciation accelerated or not. And also, are they owned versus independent contractor? This is effects on the revenue per unit. The big difference right now we're dealing with is fuel cost. And if you haven't dealt with this, one of the concerns I use, Dirk, teaching this stuff is that between $2 a gallon and $4 a gallon, today's marketplace, that could be as much as $40,000 a year worth of income. Now that doesn't mean, expenses. That doesn't mean it always relates to income, because some of our insurers have contracts with shippers that they're not able to accumulate all that. They got to cut some of their rate cost here. But the reason I point this out is that the higher fuel costs, since that's the second most costly item, drivers being paid the most costly item, the higher the fuel costs, the more pressure on the motor carrier to operate efficiently. Right now, we have, in the last year, we've had a situation where we're very favorable. So it's the cost of providing transportation. In the owned units, you got to look at depreciation, you got to look at the maintenance cost, you got to look at the cost, and you got to look at the interest they're paying on their equipment. This is expenses they'll typically have, and the more interest they pay, the higher depreciation, the more indications of all of the units that they own, and they have that cost area. So those are the things we look at. Driver pay is another thing going up. I was driving home over the weekend, and I was hearing that Walmart's offering drivers $80,000 a year. Where's the driver pay going up? And this is a benchmark now. We're looking at about $50,000 to $55,000 per unit per driver. This is what the cost is. You have the other benefits that are involved in it, like are they offering 401ks? Are they offering health insurance? How they're offering health insurance with the Affordable Care Act? How they're coordinating those kind of things. When you look at the expenses, you get a feel of their operation, a feel of what they're paying the driver, the feel of how seriously they are keeping the driver there, because obviously the more benefits they pay to the driver, the greater the driver will stay with the company. So this is a correlation there. Other things we already talked about, are they doing a garage, are they doing warehouses, what's their office expense, do they have outside sales force, and how much of the management's taking out of the money, and is that management fee reflective of actually production, or the way they handle the taxes because they're taking more out than actually what is needed because there's enough revenue there. You want to look at independent contractors. Who are they 1099? Again, trying to measure those things. And you can have other than independent contractors at 1099. Dirk, I am correct. We take the revenue of the trucks that the owner-operator generates, but they would have to also expense that out through a 1099. It's just not correct in that part of it.
So that would be a good, you think about supplemental data to get. If you got a list of the 1099s that were filed the previous year, you'd have a pretty good feel for their use of independent contractors.
Yeah, because you could have the 1099 for outside garages or if there's people doing maintenance of the building that are not always owner-operators. That's a concern. The more higher it is, more owner-operators. You have the insurance expense, auto, general liability, cargo, and property damage. For a smaller motor carrier, we already talked about it, Dirk. You already mentioned it earlier, how they account for that. A lot of times they don't properly account for the down payment. A lot of times this stuff is paid up front, which affects the cashes, but is used over a period of time. We already talked about health insurance. The work comp is auditable, so you need to understand what they might be expensing out could be adjusted later, depending on how that audit's going to be, if it's up or down right now because payroll is going up. Work comp premiums typically are generating more audit than traditional because we're increasing the pay on a regular basis and our work comp premiums paid on a monthly basis, and then the insurance on the property.
A couple of tax things. One of the things I think when a user is looking at a financial statements, recognize that small businesses, sometimes they're trying to reduce their taxes along with having an economic profit. And I think as you look at the income statement, you'll get a sense of whether the owner is using their business to enhance their lifestyle and reduce their taxes. And sometimes they'll run meals, entertainment, personal vehicles, family members on the payroll, other things that are discretionary as a way to reduce the profit. And sometimes that's done in a very prudent way, but the user should just have a sense that are all the expenses the true economic level of expenses, or are they running some personal type things through the business that are linked to a business purpose? They're legitimate, sort of a gray area, as a way to push down their taxable income to save taxes.
Well, and the point here is that some of those could be reduced later for financial strain. I mean, I just came away from a conference, and of course, some of the participants of the conference had spouses and other things, and that's all going to be, most of that's going to be expensed out, but it is entertainment for the principals.
Correct. Then the last thing would be, for me, I think, is to be aware of how the business is organized from a legal standpoint. They could be a sole proprietor, they could be a partnership, a limited liability company, an S corporation, or a C corporation. And I think for purposes of this discussion, just be aware that depending on their type of legal entity, the type of tax return that they file, the form that it's on, and how taxes are paid on that is critical and will affect the financial statements as you look at them. Most of these on this slide, individual, partnership, LLC, S corporation, the business keeps a separate set of books, but the net income, the taxable income, is reported eventually on the owner's tax return, and so the owner will take money from the company in order to satisfy their taxes. And when they do, on the books of the company, they'll show that this is a distribution of profits in order to get the cash to the owner. If they're a C corporation, that's the one type of entity that is actually a taxpayer on its own, and the corporation actually has a direct relationship with the IRS, pays its own taxes. But I think just to be aware, what legal type of entity am I working with, because that'll have an impact on the type of tax returns you'll see when you look at the business.
I'd like to spend a couple seconds here on this too, Dirk, before we get finished. And I know our time is running long, but this is very interesting information, I think, and I hope the participants understand when they ask for financial statements, when they ask for financial information, they need to understand that. Because a lot of times a smaller motor carrier only has a tax return. They don't keep all these books. They keep all the receipts, all their expenses in a used to call it a cigar box, but something else are online now. So to speak very quickly, just looking at the internal financial statements or done outside versus if all they have is a tax return?
If all they have is a tax return, if they're a sole proprietor, that is, they're not even a legal entity, then on their Form 1040 that we all file with the IRS, there's a separate schedule for businesses called Schedule C. And you'll see the income statement right on their personal tax return. Other entities like a partnership, a limited liability company, or an S-corp, those entities file a separate tax return, either a Form 1065 or an 1120-S. But those entities do not send in taxes. Instead, as a part of filing the business tax return, there will be a schedule called a K-1 that shows how much the taxable income is, and that for the owner, and that K-1 is produced and gets put onto the owner's tax return on a Schedule E, where the net income or net loss of the business will show on the owner's Schedule E of their Form 1040 as a net income or loss, and then that owner has to pay personal income taxes on the profits of the business. And then they'll usually take the cash out of the business, recording it as a distribution or a dividend in order to come up with the cash in order to pay the taxes.
And that's the important part here, because if you only have a tax return and it's a sole proprietorship, a lot of this detail that Dirk and I were talking about as far as the debt and the value of the equipment depreciation isn't going to be as itemized as you're finding on a true financial statement. So most of businesses today, again, unless it's a one-person motor carrier, has some kind of internal bookkeeping. And I will recommend to get both if they can get it, Dirk, for the individuals, both the tax returns and the other. The second part of it, if it's a partnership or LLC, again, that K-1 is important, because you then will not have the individual tax return, you'd have the business tax return and or the business financial statement. So really how to interpret the personal tax returns and the personal business as it deals with the number of units. Now, most of the time, someone, when they get more than 5 or 8 units, if they follow any kind of advice for any lawyer, they are LLC or an S corporation, at least in those areas, just for protection of the assets of the company. So typically we will look at the balance sheets, and you can just give me an opinion on this, because my personal thought is that the balance sheets are more accurate than the tax returns for looking at the businesses in themselves, other than, again, an individual.
That's right. Although LLCs and S corporations and C corporations, they have a balance sheet right inside the tax return that I would say is also fairly accurate. So for those types.
Well, of course, the more accuracy you got, you signed it, you sent it to the government. My comment is you don't lie to the government except maybe April 15th, right? So that. Okay, do we have one more slide here? Let's see what.
Really,
again,
things we've just already covered, to say that an owner can take money in several ways through their business, through payroll, through running expenses through the business, their benefits, and then they're also entitled to the profits, both profits to put in their pocket and also to cover their income taxes. And so I think just for a person, the reader of the financial statement, the tax return, to be aware of how they're taking the money out of the business, and is it economically reasonable, or is there some manipulation going on for tax reasons?
Okay, what's the last one? Okay.
And this is it, the financial management goal, just trying to make sure that is there adequate profitability and a sound balance sheet, which allows the business to hire good people and maintain equipment, and of course pay their insurance premium.
Yeah, and I had a comment that some of you heard me make before, is that I asked the loss prevention person one time about what's the difference when the owner-operator was working for Schneider National or Swift or someone like that. Now that they're out on their own, how are they different than when they were operating there as far as operating their equipment? And his comment is as simply as, when they're working for Swift, when they're working for these large trucking, they don't have to worry about eating. Once they're out on their own, now they're going to have to worry about eating. So that adds a different stress on the management of the things we talked about. And the proper management, they don't accrue for the depreciation. They don't accrue for the flat tire, where they don't worry about that much when they're working for the bigger companies. That's the big part of this as we look at the financial ability of our insurers to stay in business, as well as looking at the financial information to determine their operation and are we getting the proper, are we accounting for the proper exposures and getting the proper premium for the operation. And Dirk, I think that's what we tried to say today. So
Right.
my friend, I really appreciate this. I know that your comments are well taken, and it's nice to have an expert like you. For you who are worried or who are getting involved in the conference, I've already asked Dirk to give me an hour and a half or so of this at our annual conference next year in Orlando. We appreciate your time, and we hope all the participants got something out of it. Dirk, have a good weekend.
Hey, thanks, Tommy. So long.